The stock market has been breaking records in 2025 with the indexes at all-time high and investor confidence climbing. Yet despite those highs, many great companies are still trading at fair or even discounted prices. The big question is, which stocks are actually worth holding on for the next decade? Today I am breaking down the top 10 of the best stocks to buy this month in August 2025. These are companies with strong balance sheet, powerful brands, and long runways for growth. But this will not just be a list. I will personally walk you through their history, their challenges, and the reason why they start out right now. And before I begin, there's something I want to make things clear. This is not a financial advice. This is educational content to help you think about opportunities. Always do your own research and if needed, speak with a certified financial advisor. If this is your first time here, welcome to the channel, where we take complex finance news and break it down into clear stories. If you are returning, thank you for supporting this new project. I promise to bring you the same level of depth and in every video. So grab a coffee, because we are going deep into these 10 companies and how they could shape the next decade of investing. The first on our list is PayPal. PayPal has been around since the early days of e-commerce, originally tied to eBay. It became the backbone of digital payments long before apps like Venmo or Cash App even existed. At its peak, the stock was soaring, but over the last few years, it has dropped more than 75% from its height. What went wrong and why it might now be a buy? The short answer is competition and leadership challenges. PayPal lost some ground to newer apps, but right now, it is reinventing itself. The company now has over 438 million active users around the world, which is more than the population of the United States and Canada combined. It still processes billions in transactions every single day. New leadership is driving change. They're focusing on expanding Venmo, improving the app experience, and launching new products like cashback debit card. PayPal is also heavily investing in fraud detection and AI-driven security tools, which matter more as online scams rise. Financially, the company generates billions in free cash flows, and analysts expect around 20% earnings growth annually. This is huge for a stock that Wall Street has been ignoring for quite a while now. Before we move on, think about this. Where do you see your digital payments in 5 years? Are you using more cash or less? Now, if you're like most people, they'll say less, and that trend directly plays into PayPal's hands. The second on our list is Airbnb. Airbnb started in 2007 with just a couple of founders renting air mattresses back in San Francisco. Fast forward to today, they have over 8 million properties worldwide, covering everything from budget apartments to luxury villas. Travel has bounced back massively after the pandemic, and Airbnb is not only profitable, but also sitting on over $11 billion in cash right now. This is a serious stack of cash for future growth. What makes Airbnb special is its asset-light model. Unlike Marriott or Hilton, it does not own any hotels. Instead, it takes a cut from millions of hosts around the world. Airbnb is also innovating. They are introducing categories like unique stays, long-term rentals, and experiences where you can book cooking classes or city tours throughout the platform. On top of that, management is buying back shares, signaling they believe the stock is undervalued. Compared to competitors like Book Holdings or Expedia, while those companies are strong, they still rely heavily on hotel bookings. Airbnb's platform is broader and more flexible, giving it an edge, especially with younger generations who prefer unique travel. The next on our list is Mercado Libre. Often called the Amazon of Latin America, Mercado Libre has built an empire that goes beyond e-commerce. They run a payment enterprise which is called Mercado Pago, a logistics network, Mercado Envios, and even lending through Mercado Credito, which is you take loans from. Why is this so powerful, you may ask? Latin America has historically had lower banking access and weaker infrastructure. Mercado Libre is solving both problems. They are creating a digital financial ecosystem while also building the trucks and warehouses to move goods quickly. In 2024, the company processed billions in merchandise and payments volume. Its fintech arm is growing even faster than its e-commerce counterpart. That means Mercado Libre is not just selling products, it is also becoming the PayPal and Shopify of the region. Compared to competitors like Amazon, which is present but less dominant, Mercado Libre has the home field advantage, and with Latin America's middle class expanding, this company could see decades of growth. The next on our list is CrowdStrike. CrowdStrike is one of the fastest growing companies in cybersecurity space, and there's a good reason for it. Its Falcon platform uses AI and data from millions of devices that detects threats in real time. The more company uses it, the smarter it gets. The network effect makes it harder for competitors to catch up. Cybersecurity is no longer optional. Every government, every businesses, every hospital needs protection. The global market could reach $225 billion in just a few years, and CrowdStrike is only pulling in over $4.5 billion in annual recurring revenue. What's this CrowdStrike apart from legacy companies like Symantec or McAfee is that it was born in the cloud from day one, which means it's one of the early pioneers in cloud computing technology. That makes it faster, more scalable, and better suited for the modern internet. For investors, cybersecurity is like digital insurance. You hope you never need it, but you absolutely cannot ignore it. CrowdStrike offers a way to invest in that reality. The next in our list is, everyone knows about it, Shopify. Without getting into too much detail, it powers millions of online businesses, from small startups selling handmade goods to big brands looking for independence from Amazon. Shopify provides software, payment tools, and marketing support to run e-commerce store. Even after the pandemic, e-commerce growth has not slowed. It now represents more than 15% of all retail sales in the US, and that number is still climbing. Shopify is well positioned to ride that wave. Its platform alone handles everything from handling billions in sales every quarter. What makes it very too appealing to everyone is its ecosystem. Sellers can plug into apps, hire freelancers, and even borrow money directly from Shopify. That creates stickiness. Customers rarely leave once they're set up. In the e-commerce world, Shopify ranks number 2 in the US behind Amazon. Now that might not sound like much being second place, but you have to consider the scope and size of Amazon. Amazon's nearly untouchable in size. The fact that Shopify isn't competing shows how strong the company is financially. The next on our list is a company called Intuitive Surgical. If you haven't really heard of this company, you're not alone. I was shocked when I was researching for this video. Intuitive Surgical is the pioneer of robot-assisted surgery. Its Da Vinci surgical system dominates the market with an 80% global share. The company makes a recurring revenue from surgical tools and procedures, giving it a stable financial base. In the second quarter of 2025 this year, revenue grew 21% year over year, fueled by increased adoption of the Da Vinci system. With hospitals around the world investing in robotic surgery, the potential growth runway is enormous. For investors, Intuitive Surgical represents a combination of technological innovation and long-term healthcare demand, a rare combination that can provide steady growth and resilience in uncertain markets. The next on our list is everybody's famous Disney. The last couple of years hasn't been too kind to the company itself. Disney is what used to be an animation studio is now a conglomerate. Disney owns theme parks, it has movies, streaming services, cruises, world-class intellectual property. Disney Plus, the company's streaming services, now has 126 million subscribers. Hulu contributes a couple of millions more, and the company is generating strong cash flow from its parks. Disney has a unique combination, a reliable cash-generating businesses that are its parks, a tech-forward growth businesses streaming, with brands like Marvel, Star Wars, Pixar, and ESPN+. Disney is positioned to grow even as consumer habits shift. Additionally, Disney is investing $60 billion in parks and cruises over the next decade, ensuring long-term revenue streams. This makes it an all-weather stock suitable for both growth and defensive portfolios. And the recent announcement by investors saying that the company will no longer the ESG guidelines by the BlackRock also shows promise in the leaderships. The next company on our list is the famous company run and managed by the famous Warren Buffett himself, Berkshire Hathaway. Berkshire Hathaway is the classic value pick. It owns over 60 businesses, including household names like Geico, Duracell, Dairy Queen, as well as a $283 billion stock portfolio with Apple, Bank of America, and Coca-Cola. The company also holds $344 billion in cash, giving it an unparalleled flexibility to make acquisitions or invest in new opportunities. While it may not offer the rapid growth of tech stocks, Berkshire provides stability, strong returns, and a proven investment culture, even as Warren Buffett prepares to step down. Trust me, the guy is close to 100 years right now. I don't know how he keeps doing it. The next on our list is Amazon. Amazon dominates US e-commerce and cloud computing through AWS. Cloud computing is expected to quadruple by 2032, giving an already powerful Amazon enormous growth potential. Retail is still growing online, and Amazon's infrastructure, logistics, and brand dominance makes it nearly impossible for competitors to catch up. Amazon is also expanding into healthcare, grocery, and local markets, offering multiple long-term growth levers. As long as it doesn't get itself into too much controversy, I think Amazon could be a good pick. And last but not the least, Google, also known as Alphabet. It runs services like pretty much everything you use the internet for: YouTube, Android, Gmail, Chrome. Its main growth drivers is Google Cloud, and now competing with AWS and Microsoft's Azure. Alphabet's other bets include Waymo and other early-stage technologies. While these are not yet revenue generating, they represent potential massive long-term growth. Alphabet is also highly profitable, cash-rich, and has recently started paying dividend, which a lot of tech giants don't really do. But Google is in a place where they can do it. So what do these 10 companies have in common? They dominate their industries. They continue to grow despite size or competition. They focus on the long game, not short term. Remember, also, I can't emphasize this enough. This is not a financial advice. Please do your own due diligence. Always research each company, and this might be an expensive option, but please hire a professional like a financial advisor or something. The safest way to diversify is with something like the Vanguard S&P 500 ETF or the Vanguard Total World ETF. But if you want direct stakes in individual companies, these stocks are strong and need to research further. Now, I want to hear from you. Which of these 10 stocks would you buy today? And drop your thoughts in the comments. Since this is one of the first videos on this channel, let me know what other types of financial topics you would like to see. Your ideas will help me make more content. If you found this video helpful, hit the like button, subscribe, and share it with your friends or anyone looking for smart investing insights. Thank you for watching, and until next time, invest wisely.